Hi students, welcome to Commerce Veda. Few of the students asked me to do answers for MTP Management Accounting. So for CMA-INTER examination December 25. Let us quickly do the solutions for set 1 and set 2. First we'll complete set 1 and the next video will be on set 2. The first question is, creation of value through effective use of resources is the focus area. Generally, value creation comes at 4 stages. The stage 1 is about, stage 1 is all about material, cost. Stage 2 is about information for management planning. Stage 3 about reduction of wastage in process, and stage 4 is about value creation. Hence, we should go ahead with answer D. Which personnel of a financial firm play a key role in management accounting? Obviously, managers. So it is C. Now, activity-based costing would probably provide greatest benefits for organizations that use. There, in job costing, you normally do absorption costing or all these overhead apportionment and all. Instead of that, if you do activity-based costing, your job costing will be more beneficial. So I can say option A. Now, which of the following activities is not a batch level activity? Purchase orders, batch level activity. Raw materials, batch level activity. Setting up an equipment is a batch level activity. So if I do yes, one is missing, that is B. Designing the products is not a batch level activity. Now comes the problematic part. Determine sales in rupees for desired profit if fixed cost. So formula here is fixed cost plus desired profit divided by PV ratio. So your PV ratio is sales minus variable cost, your contribution by sales into 100. Your sales minus variable cost is 50 minus 30, 20 by sales 50 into 100. So it is 40%. At a 40% PVR, fixed cost is, how much is fixed cost? Fixed cost is 10,000. Desired profit is 5,000 by 40%. So you will get 15,000 by 40%. 37,500 is your option. Here option D is for fifth question. So very simple question. Go ahead. For the coming year, a manufacturing company has budgeted as under contribution 45%. That means contribution by sales equals to 45% PV ratio, and fixed cost is given, and it says margin of safety 33.1. It should be 33.1/3 because the option 33.12, there is no option given in the question. Now let us see fixed cost 5,85,000. See, basically what is your BEP? BEP is fixed cost by PV ratio. So my fixed cost 5,85,000 by PV ratio 45%. So my BEP is 13 lakhs, which is 5,85,000 divided by 45%. Now when BEP is 13 lakhs, it says margin of safety is 33.1/3. Means what? Margin of safety is 1/3. So BEP is 2/3. In a sale, we have two things, BEP and MOS. If BEP is 13 lakhs, MOS should be 13 lakhs is 2/3. So 1/3 is 650. So when you know your MOS, profit equals to, profit at MOS is nothing but, profit at MOS equals to MOS sales into PV ratio into 45%. So 6,50,000 into 45%. The answer should be 2,92,500, option B. So at MOS, contribution equals to profit. So when the MOS is 650, contribution 45%, which is 2,92,500. At MOS, contribution equals to profit. Hence your profit is 2,92,500, option B. Come here. Seventh question. A company has a break-even point when sales are 3,20,000. When sales are 3,20,000, you are at a break-even point, means no profit, no loss. Variable cost at that level is 2 lakhs. It means at a sale of 320, variable cost is 2 lakhs, contribution is 1,20,000. Right. So what is the current? It says how much contribution margin will increase or decrease if variable expenses are dropped by 3,000. Generally, when variable cost drop, your contribution will increase. Here, what is the contribution ratio? 1,20,000 by 3,20,000, which is 37.5% is the existing contribution ratio. New ratio, your sales are 320, your variable cost dropped by 30,000. So variable cost becomes 170 and the profit is 320 minus 170. 1,50,000 is the contribution. This is your contribution. Now the margin, PV ratio, contribution by sales 320, new PV ratio is 46.875%. So the old PV ratio is 37.5, new PV ratio is 46.875. 46.875 minus 37.5 is increased by 9.375%. The option is B, increased by 9.375%. So this is the simple way of identifying the solution. Simple, compute the current contribution, compute the new contribution, compute the current PV ratio, compute the new PV ratio. The difference is what? Increase or decrease. Whenever variable cost decreases, PV ratio increases. Next, which of the following are not the method of transfer pricing? Which of the following are not the method of transfer pricing? So we have four options: total cost method, marginal cost method, market price method, skimming price method. Yes, total cost method. Yes, marginal cost method. Yes, market price method. This is not the method. It is actually a strategy used while launching the new product. So this is not the solution. So D is the answer. Now next, XYZ factory working for 50 hours per week. This is an important question. Just focus on it. XYZ factory working for 50 hours per week. 100 workers. So the standard output is 200 units per gang. Standard output is 200. So for every 100, so 200 by 100, standard output is 2 per hour. 200 is the output for 100 gang. So 2 per hour is a standard output that you should see, and standard rate is 1 per hour. So standard rate 1 per hour, hence standard rate per unit is 1 by 2, 0.5 paisa per unit. It means 100 employees, 100 workers should produce 200 units. Then that means 100 employees should produce 200 units per hour. In the sense, actually each employee should produce 2 units per hour, and I am paying 1 rupee per hour. So the standard rate per unit is 0.5 NP. Keep it in mind. During a week in June, 5 employees were paid 120, 180, and then 10 employees were paid 80 per hour. So rest of 1 were paid at standard hour rate. So during the week in June, 5 employees were paid 1.2 per hour, 10 employees were paid at 80 paisa per hour, rest of the employees were at standard rate. Now, total number of units produced was 10,200. So 10,200 is number of units produced, 10,200 number of units produced into 0.5 standard rate. Your standard cost should be 10,200 into 0.5. Your standard cost is 5,100. Standard cost is actual production into standard rate, actual production into standard rate per hour. Right. Now, you should also see what is your actual cost. This is your standard cost. Done. Your actual cost is 5 employees you paid how much? 5 employees you paid 1.2 per hour. 1.2 per hour, 50 hours. So 5 into 1.2 into 50, 300, and 10 employees you paid 80 paise per hour. So 10 into 0.808 or 0.8 into 50. So 10 employees you paid 80 paise per hour. So 400. And the rest is how much? 100 minus 10 minus 5, 85. Balance 85 employees you paid at standard rate per hour. Standard rate per hour. So 1 into 50. 85 into 1 into 50, you paid 4250. So your actual cost is 4250 plus 400 plus 300 is 4950. So actual cost and standard cost. Standard cost is 5100, actual cost is 4950. So standard cost minus actual cost is your variance. Cost variance is 150 favorable. So see, your cost variance is 150 favorable. Why? Because your standard cost is 5100 and actual cost is 4950. Very simple solution. Don't try to implement big tables and all. A simple logic and close the answer in quick time. So once this answer is done, we'll move to the next question. What is the labor rate variance if standard hours are 100 units of output? If standard hours for 100 units is 400. To produce 100 units, standard hours are 400 at 2 per hour and actual hours 380 at 2.25 per hour. See, what is this called? Rate variance, right? It says rate. Rate variance is nothing but what? Standard rate minus actual rate into actual hours, right? So what is your standard rate? 2. What is your actual rate? 2.25. What is your actual hours? 380. So 380 into 380 into minus 0.25. So 95 adverse. The answer should be C. 95 adverse. The answer should be C. Should be the answer. Then we finished 10 questions. Now next. Purchase budget is prepared using the information from purchase is not capital expenditure. So when A is not applicable, C is not applicable, but purchase is based on material, hence D is not applicable. The answer is B. Now, which of the following, not one of the main important parts of Kalpan-Norton balanced scorecard concept? So out of the 4 points, we'll see financial and non-financial measurements, yes. Short-term and long-term measurements, yes. Leading and lagging indicators, yes. It is more of a study. So what is not exactly fit in this Kaplan-Norton balance scorecard is B, which is cash flows and non-cash flows. A very simple question. It is more of a financial, short-term, long-term and leading lagging indicators. So cash flows comes only when operating things. So this is not a part of your Kaplan-Norton balance scorecard concept. The next, 3 departments A, B, C, or in a company, the sales of A, B, C are given. So I'll just write A, B, C. We have the sales. What are the sales of A? 3.52 and B 2.88 and C 1.6. We'll keep the sales information just quickly writing down. Variable costs were 2.4 and 1.76 and 1.44. So sales minus variable cost were given 3.52 minus 2.4. We're quickly writing the information. 1.12 is the, because it's about ranking. Contribution 2.88 minus 1.76. The contribution again here is 1.12 and here 1.6 minus 1.44. 1.6 minus 1.44. The contribution is 0.16. And it says fixed costs are given 0.28, 0.224 and 0.128. So when you compute the profit, this is fixed cost. When you compute the profit, 1.12 minus 0.28, here is 0.84. So 2.88 minus 1.76, 2.88 minus 1.76, 1.12, 1.12, yes, minus 0.224. This is 0.896. That means this is 84,000. This is 89,600, and this is 0.16 minus 0.128, 0.032. That means 3,200. If you see profitability, this is rank 1, this is rank 2, this is rank 3. So B should be rank 1, A should be rank 2, and C should be rank 3. Answer is B. Simply compute the profit for each 3 products. Sales minus variable cost minus contribution. Sorry, sales minus variable cost contribution, contribution minus fixed cost profit. So high profit is coming at B. So B is more profitable. A is next and C is, all the 3 are profitable, but in terms of ranking, B should be 1, A should be 2, and C should be 3. Moving to the next question. Circumstances that influence the profitability of decisions are referred to what? Basically, decision. In decision theory, the state of nature refers to the circumstances or conditions like market conditions, economic conditions, competitor actions. So the state of nature is referred to the circumstances that influence the profitability of decision referred. So if you see here, strategy, no, this is no, this is no, the answer is C, state of nature. State of nature is referred to the circumstances or conditions which will affect the profitability. Right. Then next, a strategy that yields an expected monetary payoff of 0. Expected monetary payoff of 0 is, in long term neither party has an advantage. In long term, wrote down, in long term neither party has an advantage. It means it's fair game. Neither party has an advantage. So I can say a strategy that yields expected monetary payoff of 0 is fair game, because it should be beneficial to both the parties. So neither party, I'm sorry, my writing is very poor, especially on this it's even more poor. So neither party, it's like beneficial to both parties. No one takes an undue advantage. So that is called what? Fair game. So these are the 15 MCQs in detail we discussed. We did workings as well. You can refer this quick reference and do in the exam. We are joining with another video of set 2 of the same question paper, the same management accounting, the same paper, set 2 answers soon, maybe in half an hour's time. Thank you.